Imagine looking at a company's quarterly report. The stock is surging, and they're posting record-breaking numbers to Wall Street. But when you look at the actual cash coming in the front door, the flow is completely flat. This slide outlines common accounting discrepancies used to create that specific illusion. Notice the primary question: how can profits increase while revenues remain flat? In the physical world, the answer is often depreciation. When a company buys a delivery truck, normal wear and tear reduces its value over time. This document defines it as the gradual reduction in the value of an asset. But on a spreadsheet, depreciation acts as a phantom expense. Because the cash was spent years ago, the annual write-down is just a theoretical number, and that makes it highly vulnerable to manipulation. The incentive to twist that theoretical number is found at the bottom of our previous slide. Recording depreciation legally reduces taxable income. Since no actual cash leaves the bank account, the exact size of the expense is based on management's own estimates. This creates a direct conflict between accurate reporting and the pressure to boost paper profits. This training slide makes the risk clear. Because it is a non-cash expense, depreciation is the single most susceptible line item for corporate manipulation. To find a company's true financial health, we have to look past the top-line numbers and interrogate the math. Catching deception requires an understanding of the 3 legitimate formulas accountants use to calculate asset decay. These are the levers executives use to shape their reports. This slide shows the most common tool, the straight-line method. It is the simplest approach, dividing the total expense equally across every year of the asset's life. Next is the written-down value method. As the text here explains, this approach is front-loaded, taking a massive expense hit in the early years that reduces over time. Finally, this note outlines the units of production method, which abandons the calendar entirely and bases decay strictly on physical output. By simply choosing one mathematical formula over another, management can change the entire shape of their financial narrative for the year. This slide details how these tools are weaponized. Overstating depreciation unfairly shrinks tax obligations. Executives can also do the opposite, stretching an asset's useful life to shrink the annual expense and inflate net profits. This allows massive profits to appear on an earnings report without the company selling a single additional product. These dry mathematical formulas are often the primary hiding spots for corporate deception. To find the truth, you have to adopt a forensic mindset, actively looking for the red flags that suggest the math doesn't match reality. Look at the checklist on the bottom. The first red flag is a peer disconnect. If a company uses a different depreciation policy than its industry, it's a warning sign. We also look for sudden changes in depreciation methods or arbitrary shifts in asset life. These unprompted shifts rarely reflect a change in the equipment itself. Usually, they are a way for executives to patch holes in a failing financial quarter. Consistency across time and industry indicates honest accounting. Sudden shifts are the fingerprints of a manufactured narrative. The final phase of the investigation looks for the moment the spreadsheet completely contradicts the physical world. Look at this question. If profits skyrocket while revenue flatlines, the depreciation lever was likely pulled. This leads to our third red flag, the CAPEX mismatch. If a company reports significant capital expenditures for new equipment, its annual depreciation expense should logically increase. When new equipment costs go up, but the depreciation expense stays flat, the math breaks. It is a clear sign that a company is hiding costs to appear more profitable to investors. Depreciation math provides a rare window into corporate honesty. A sharp investor checks these formulas to ensure the profits on the page aren't just a phantom illusion.